Opendoor Technologies, Inc., trading under the ticker OPEN, is currently priced at 4.45, with a day's range of 4.21 to 4.93, a notable change from its 52-week low of 0.508 and high of 5.87. While many are focused on the recent dramatic price swings, driven by a cocktail of meme stock fervor, strategic shifts, and a volatile housing market, the true story lies not in the daily volatility, but in a far more profound, silent transformation. What most investors miss is that Opendoor is no longer just an iBuyer. It is quietly but forcefully pivoting from a capital-intensive, high-risk home flipping model to a capital-light, transaction-focused platform. This isn't a minor tweak. It is an existential, strategic evolution. The core of their business is shifting from buying and selling homes themselves to facilitating a new kind of real estate transaction, one that leverages their data and technology without taking on the crushing balance sheet risk that nearly sank them in previous downturns. This change fundamentally alters the risk-reward profile of the company, and it's this unheralded shift that holds the key to its long-term viability, a reality that stands in stark contrast to the market's expectation that Opendoor is just a cyclical bet on the housing market's health. The prevailing narrative about Opendoor is that it is a direct proxy for the health of the U.S. housing market. When interest rates are low and home prices are rising, the iBuying model flourishes because the company can acquire homes cheaply, renovate them quickly, and sell them for a predictable profit. Conversely, when rates spike and the market freezes, their inventory sits, losses mount, and the entire business model looks fundamentally broken. This belief is not without merit. The company's past performance is a testament to this cyclical vulnerability. However, this perspective is dangerously incomplete. It fails to account for the company's aggressive and frankly surprising pivot toward an agent-led, multi-product ecosystem. This is the contrarian insight. Opendoor is now less of a pure iBuyer and more of a tech platform providing a suite of services. The company's recent actions, including its Key Connections program, are the strongest evidence yet. This program, which saw a successful pilot and is now expanding, is designed to align with and empower real estate agents, not to replace them. It offers agents a reliable stream of clients and a fast cash option for their sellers. This strategic shift is a direct response to a changing market and the painful lessons learned from the last housing cycle. By partnering with agents, Opendoor leverages their established networks and local expertise, effectively outsourcing the most unpredictable part of the business, the home acquisition process, while still capturing a slice of the transaction value. This reduces Opendoor's capital expenditure, limits its exposure to inventory risk, and positions it as an essential partner in a fragmented industry, rather than an aggressive disruptor with a target on its back. Diving deeper into this strategic pivot reveals a calculated move to de-risk the entire business model. The traditional iBuying process requires Opendoor to use vast amounts of capital, often through debt, to purchase homes. These homes then sit on their balance sheet, exposed to the whims of the housing market. A sudden drop in prices or a prolonged slowdown in sales can lead to massive inventory valuation adjustments, as seen in past quarters. The new agent-led model, however, is asset-light. The company provides a technology platform, data-driven offers, and a streamlined closing process. But the agent handles the marketing and the client relationship. This isn't just a simple diversification. It's a fundamental change in the unit economics. Instead of making a large, one-time profit on a single home flip, which can easily turn into a loss, Opendoor is now aiming for a smaller, more consistent fee on a much higher volume of transactions. The application of this is clear in their latest results. Despite a challenging housing market, they are reporting improved operational discipline and a return to positive adjusted EBITDA in the most recent quarter. While home purchases were down significantly year over year, a metric that would traditionally be seen as a negative, it is a direct result of their new, more cautious and capital-efficient strategy. This reduced acquisition volume is not a sign of weakness, but a conscious choice to prioritize profitable transactions over sheer volume, a crucial distinction that most market observers overlook. The framing of this matters immensely. It suggests that Opendoor is moving towards a SaaS-like or B2B model, selling services to agents and homeowners rather than being a high-volume, low-margin retailer of homes. This shift is critical for investor sentiment and long-term valuation, as it moves the company away from being judged purely on its ability to perfectly time the housing cycle. Beyond the strategic pivot, the financial underpinnings of this transformation tell an even more compelling story. The most recent quarterly earnings report, for example, beat revenue expectations, a significant positive signal given the macro environment. However, the more granular details reveal the true progress. The company achieved its first quarter of adjusted EBITDA profitability since 2022, a monumental achievement that proves the new disciplined approach can work. This profitability was driven by a combination of factors, including widening offer spreads to manage risk and a sharp focus on operational efficiency. The company is no longer chasing market share at all costs, a strategy that led to significant losses in the past. Instead, it is prioritizing margin and profitability, a much healthier and more sustainable path. While the forward guidance for the next quarter indicates a potential sharp contraction in revenue, a fact that has spooked some analysts, this should be viewed through the lens of their strategic shift. The company is actively choosing to sell fewer homes at higher margins rather than buying up everything in sight. This isn't a sign of a failing business. It's a sign of a maturing business that has learned its lessons and is now optimizing for cash flow and profitability. Furthermore, the company's inventory balance has decreased substantially, which directly reduces its exposure to market volatility and frees up capital. This is an application of a core financial principle. In a volatile market, liquidity is king. Opendoor is building a fortress balance sheet by reducing its physical inventory and shifting to a model where its assets are its technology and its relationships, not millions of dollars worth of houses. The framing for investors is this: the company is transitioning from a business that is a slave to the housing cycle to one that can be a resilient and profitable participant in it, regardless of market direction. The broader market context further amplifies the significance of Opendoor's shift. The entire real estate industry is grappling with profound changes. Rising interest rates have made homeownership less affordable, slowing down the pace of transactions. At the same time, a structural shortage of housing inventory in many key markets creates a unique supply-demand dynamic. Opendoor's new model is perfectly suited to navigate this complexity. By not relying solely on a high volume of transactions, it can survive periods of market stagnation. Instead, its focus on providing a seamless, convenient, and predictable selling experience becomes a key competitive advantage. In a market where traditional sales can be slow and fraught with uncertainty, Opendoor's platform, even in its agent-led form, offers a much-needed alternative. This also positions the company to compete not just with other iBuyers, like OfferPad, but also with traditional brokerages and emerging real estate tech players. Opendoor is essentially building a two-sided platform. It serves homeowners who want a quick, certain sale and agents who want a reliable source of qualified leads and a powerful tool to close deals. This platform-based approach has proven to be highly scalable and defensible in other industries, and it could provide Opendoor with a durable moat that the old iBuying model never truly had. The macro framing here is a move from disruptor to enabler, a more mature and sustainable position that allows them to thrive in a more complex and competitive landscape. The company is not just adapting to the market, it is actively shaping a new role for itself within it. In conclusion, the current fascination with Opendoor's day-to-day stock volatility and its meme stock status obscures a much more compelling and important reality. The common expectation is that Opendoor's fate is inextricably tied to the health of the housing market, making it a high-risk, cyclical investment. However, a deeper analysis of its recent strategic shifts and financial results reveals a company in the midst of a profound and deliberate transformation. Opendoor is moving away from the capital-intensive, balance sheet-heavy model that nearly broke it, and is instead pivoting toward a capital-light, service-oriented platform that partners with, rather than competes against, traditional real estate agents. This pivot, though largely unacknowledged by the general market, is the key to its future. By prioritizing profitability over volume, de-risking its balance sheet, and building a more resilient business model, Opendoor is setting itself up to be a long-term player in the real estate tech space. The contrast between expectation and reality is clear. This is no longer a simple bet on home prices. It is a calculated wager on a strategic evolution that could finally unlock the long-term value that the company's technology always promised.